Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Wednesday, 3rd September. Coming up on the show, a judge rules that Google does not have to sell Chrome, sending shares of its parent company Alphabet soaring in the pre-market. The global bond sell-off deepens as 30-year Treasury yields get very close to that 5% level. And we'll explain why September is traditionally a bad month for investors. So grab your coffee and let's own the morning. Well, our top story today is Google and its victory in a Columbia court. A federal district judge ruled that Google won't be forced to sell Chrome after he said that divestment was, quote, a poor fit. In this landmark antitrust case, Judge Amit Mehta, though, he did say that Google would have to share data that helped it hold on to its search monopoly. The ruling sent shares soaring in the pre-market, as you can see. At one point, they were actually up over 8%. Another key part of the decision means that Google can continue to make payments to distribution partners for preloading or placement of Google Search, Chrome or Gen AI products. That allows for Google to continue to make its $20 billion per year payments to Apple in exchange for the iPhone maker using Google Search as the default search engine in its Safari browser and Siri. And guess what? That sent Apple shares higher in the pre-market too, up there almost 3.5% as you can see. Well, the Justice Department had pushed for a forced sale of the company's search business and for the judge to order an end to multi-billion-dollar contracts that have all but assured Google's market dominance. Moves the judge denied to make. Judge Mehta also declined to grant the DOJ's request for a contingent divestment of Google's Android operating system, writing that the government, quote, did not present any evidence to justify a contingent structural remedy. Now, before we move on to the other headlines of the day, while the big tech sector celebrates getting more clarity on antitrust today, there are other sectors that are growing more nervous. Manufacturers, for instance, they're trying to navigate continued uncertainty over tariffs and the new global trade order. Susan Spence from the Manufacturing Business Survey Committee shared her insights with Yahoo Finance.
Number one, they need a deal. They need a deal that's not going to change. Obviously, deals that increase input costs from a 30% tariffs aren't great either. But I hear more comments about the uncertainty, and then of course, and not secondary is how much is that tariff increase? So if their customers aren't ordering, like in the trucking, the transportation equipment industry, if their clients aren't ordering because they don't want to pay those high prices or they're holding off, that's not going to change until what happens? Certainty. When everything's whipping around, changing, and your input costs are going up, if you can, you're going to just sit still and you're not going to do anything, right? It's a little like the consumer, right? If you've got your basic ingredients that you need to buy, right? Eggs, milk, sugar. But there's things that you would normally have no issue with buying. And if your prices are up 30%, you're just not going to do it. So they need certainty, they need policies, and they need to believe it won't change. And that last thing is really, really hard, especially now.
Okay, well, we kick off three things, not looking at the equity market for once, but the bond market. Why? Well, global bonds are facing renewed selling pressures. This is down to jitters around inflation, debt sales, and fiscal discipline, eroding sentiment toward what's had previously been some of the world's safest assets. Take the yield on 30-year treasuries. They are testing that 5% level again today. Globally, in the UK, 30-year bond yields hit 5.75%, the highest since 1998. And in Japan, the yield on its 20-year bonds, well, they hit the highest this century. The strains across sovereign bond markets come as major economies face twin challenges of managing large debts and trying to boost growth without sparking inflation. Okay, the second thing to know today, well, President Trump, he's called it a meeting to, quote, conspire against the United States. The leaders of China, Russia and North Korea gathered in Beijing for a rare symbolic summit which has very concrete financial implications. You can see here that Xi Jinping, Vladimir Putin and Kim Jong-un displaying their unity during a highly choreographed event that culminated in a showy military parade featuring stealth fighters, hypersonic missile and nuclear-capable hardware. Beyond the spectacle, Russia and North Korea are tied by a comprehensive strategic partnership which involves North Korea supplying weapons for the war in Ukraine and Russia helping out with food and energy despite international sanctions. By bringing together Beijing, Moscow and Pyongyang, Xi Jinping is setting the stage for more cooperation in energy trading and defense cooperation. For example, a major new gas pipeline in China and Russia. And ultimately, even as they compete in some areas, the three countries are looking to grow their economic ties. Analysts call it the, quote, axis of upheaval, as the three countries try to counter America's global dominance. And finally, very quick one, markets are bracing for JOLTS today. JOLTS stands for Jobs, Openings and Labour Turnover, dropping today at 10 a.m. Eastern Time. It's a leading gauge of the US labour market. A higher than expected openings count can fuel inflation concerns and nudge the Fed closer to rate hikes, while a softer reading could offer a sigh of relief, at least until the big jobs data drops on Friday. Now, Salesforce is reporting today after the bell. Let's look at the share price. It's now roughly flat, but we can expect some moves later today. Steve Koenig, head of US technology research at Macquarie, shared his tips on Yahoo Finance on what we should be looking for.
With Salesforce, it's going to be all about the numbers. I think there's nothing that Mark Benioff can say about their AI strategy that's going to change investors' opinions, but it's really going to be about the numbers. And we're not trying to call this print for Salesforce into the quarter. If they can make the upper end of their guidance, that implies that there's going to be a positive inflection in their sequential revenue additions for their subscription revenue, and those sequential additions have actually been falling year on year for almost like 12 quarters for Salesforce. So that could be a positive sign if they can just make those numbers. It could help shore up some investor confidence. But ultimately, I think what investors, many of them are hoping that Salesforce can grow double digits again, and now they're in the high single digits, and there's a hope that AI can propel that. We think that's going to be a tough challenge to move the needle on, at least on organic growth at Salesforce, to get that back into double digits. We don't think in the near future AI is going to be doing that. Maybe a few years out, but not in the near future.
Now for a quick break, but stay locked into Market Sunrise to get some expert analysis from friend of the show, Jared Blickery, and find out the lineups for today's trending stocks ahead of the US Open. Welcome back to Market Sunrise on Yahoo Finance. And as September trading kicks off with a mixed picture, let's take some time now to hear from our colleague Jared Blickery. He crunched the numbers for us to bring analysis for us on seasonality. That's the predictable data trends that happen every year. September is generally a very tough month for investors, but here's how you could play it.
September is off to an ominous start, with the S&P 500 having its worst day since the start of August. In fact, all the major indices, plus the small cap Russell 2000, they have been down 4 of the last 5 Septembers. And on today's Stocks in Translation, we're going to go back even farther in history to see why September typically has a downside edge for investors. So first, a quick reminder. Seasonality refers to a predictable and recurring change in data that tend to happen at the same time every year. And this first chart is looking at each calendar month and what happens on median, and that's almost like the average going all the way back to 1990. And what stands out right here is September. That is the only one that has a negative result. It's only slightly negative, but nevertheless, you tend to have a lot of more bullishness surrounding it, especially in the month of October and November. Now, I want to take a look at 2 different market maps that I have plotted here in green and blue, but first I want you to recognize the white and what has happened. This was the post-Liberation Day sell-off that we saw there, and of course, historical patterns could not foresee that, but nevertheless, we have recovered, and if you take a look, the actual price, which is in white here, has reclaimed the model that is a median since 1990. So not like it almost never happened, but we are right back up on track, up 9-10% for the year. Now, the blue line is constructed a little bit differently, goes all the way back to 1928, but it only includes those calendar years where you have the same day of week. And that just kind of aligns it with the holiday schedule and also with the way that people tend to deposit money in their accounts, getting payroll deductions every 2 weeks or so. So what you'll notice is the blue line up here ends at about 25%, and we're looking at the green line somewhere in the high teens here. Either way, it would project some upside for the rest of the year. But if we focus on August alone, we can see a little bit of a hiccup here in the end of September. You see both of these models peak either in mid or in late September, but then they drop off, and the green line in particular, that's the median since 1928, that falls pretty sharply into the end of the month. Doesn't mean that this has to happen, but what we want to watch out for is tendencies. And I want to show you one more market map, and this is going to be the VIX, and I think this illustrates a very important point. This is the average VIX level going back to 1990 in white right here. So it's kind of like a VIX seasonality map going back to the very beginning. And then in green, we have what's actually happened this year. So in green, again, here is that big post-Liberation Day spike that we saw, and that was just indicating a lot more fear in the market. And when the VIX goes up, you tend to see equities or stocks go down. So all you need to focus on right now is that the VIX, the seasonality map, is trending up. And that actually started in August, and that was something I was warning a few weeks ago, but that does tend to trend up into the end of October. And October, as we know, is a month where we've had a lot of historical crashes. Doesn't mean that you have negative performance for the month of October. In fact, it is the second best of the year going back to 1990. So it doesn't mean that you have to crash, but we need to be on alert for those possibilities. So with that seasonality map in mind, just want to say, tune into episodes of our Stocks in Translation podcast for more jargon-busting deep dives. We have new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Great stuff there from Jared as normal. Now, of course, we'll keep bringing you the news you need to be on the right side of the September trade. We'll take another quick break, but stick around to hear today's trending stocks on Market Sunrise. Welcome back. Well, here are the tickers you need to watch this morning. First up, pharmaceutical stocks are on a tear. Just look at this board. Cytokinetics ticker CYTK closed up around 40%, is up around 40%. Ionis Pharmaceuticals, IONS, surged nearly 35%, and United Therapeutics is up about 33% there, as you can see. Now, all three are now stable in the pre-market, but keep an eye on them when the bell rings. These moves are being driven by investor enthusiasm over recent clinical developments in trials for these three companies. And while the details of each company's strategy for respective new therapies are still unfolding. Now, if you step back and take a look at this group of pharma stocks this morning, well, the coordinated strength across multiple biotech names is a clear standout. We'll keep watching this space also as global trade negotiations continue to influence stocks in the pharma sector. Okay, next up is Opendoor, which is making the buzz again. The Open ticker has grown more and more popular with retail investors, and it's climbing another 5.8%, in the pre-market following a strong close last night. Opendoor closed up more than 14% last night. Shares are continuing to rally this morning, building on renewed interest from retail investors, following a couple of viral social media posts that got many people excited. And this has been a pattern for a few months now. The chart below, chart we just saw, showed that shares of the real estate platform are up more than 750%. That's right, 750% in the past 3 months. But many analysts continue to be skeptical that the fundamentals justify such a rally. Again, today, the latest moves in this stock echo earlier meme stock behavior that helped spark earlier spikes. And finally, let's talk about another big name, Tesla. It remains in focus as it's facing some of its biggest challenges yet. While its sales are plummeting in Europe and other parts of the world, Tesla grapples with the end of some key government subsidies supporting electric vehicle sales in the US. Shares are steady in the pre-market, up a little bit there, as you can see, over 1.5%, and are trading around the $335 mark after a couple of choppy trading sessions for the EV maker, which has been struggling in recent months. As competition from Chinese and European electric vehicles grows, Tesla CEO Elon Musk has been stressing that the future of the company is in robots, aka Optimus, artificial intelligence and autonomous cars. But Elon Musk has acknowledged that the current headwinds could lead to a few rough quarters for the company. But as the Tesla brand struggles to win back momentum and as the Trump government reverses earlier policies, some people in the US and around the world are starting to make the case that the real vehicle of the future is not electric. Analyst Carl Brower from ISEE Cars spoke to my colleague Julie Hyman here on Yahoo Finance.
We've got the all-new Toyota RAV4 coming soon, 2026, and it's going to be nothing but a hybrid, and it's the best-selling vehicle in this country. Same thing with the last redesign of the Toyota Camry. So mainstream cars absorbing or adopting hybrid technology, I kind of equate it to fuel injection. Once upon a time, that was an advanced technology for high-end race cars and performance cars. Now you wouldn't build a new car without fuel injection. I think that's going to happen to hybrid technology. It'll just become very dominant, because why would you waste all that energy when you're slowing down and stopping, just making heat? Why not recapture that and help you get going again, which is essentially what hybrid technology does.
Well, time for market movers, and we're going to focus on earnings this morning. And keeping on the car theme, we take a closer look at EV maker Polestar. Now, shares are up strongly in the pre-market as investors expect strong results. Why? Well, in recent days, Polestar experienced a surge in investor interest after reporting a 38% year-over-year increase in vehicle sales for the second quarter, alongside rising sector momentum and trading volume. An important factor supporting this response is optimism around ongoing discussions to lower US tariffs on European car imports, with potential benefits to European automakers should progress be made. Now, recently, the Swedish car maker that's partly owned by China's Geely and Volvo Cars announced that it would start the production of its Polestar 3 cars in South Carolina. Now, it's its first non-European manufacturing site, and the move, well, it also demonstrates that it's ambitious to expand its North American operations. Okay, next up we have Macy's, and it's just released results. Now, the results were better than expected. Adjusted earnings per share came in stronger. The sales were better than expected as well, and they've even increased the outlook for the future. So perhaps the consumer, despite worries about inflation and tariffs, is still shopping at Macy's. And look at the share price, up over 9% in the pre-market. Now, remember, Macy's owned department stores all across the US, but also owns Bloomingdale's as well. Okay, the next up we have Dollar Tree as well. It's also just released results, and their results were better than expected too. Net sales came in at $4.57 billion, which is better than what the street expected. Though, look at the shares in pre-market, down over 7.5%. And the thing here about Dollar Tree here is, though, they still insist that consumers are looking for low-price goods that are sold at Dollar Tree. Now, the CEO of Dollar Tree has actually said, though, that he's really impressed by the results. And don't forget, they sold Dollar Family earlier this year for $1 billion, which was a bit of a strain on the company. And he says that now that that sale has been completed, they can really focus solely on the Dollar Tree brand. Okay, now let's take a beat now to hear from Kate McShane from Goldman Sachs, who spoke to Josh Lipton about consumer spending analysis.
I mean, we have this discretionary cash flow analysis that we do at Goldman Sachs. It's basically a measure of how much cash flow the consumer has, and we're able to boil it down between income quintiles. And the fastest growth has come at that middle to higher end income quintile versus the lower income quintile. The lower income quintile, they are employed, as are the upper, middle, and upper, but inflation has weighed on them a little bit more. And that's an ongoing issue.
So as you try to model this out, okay, what do you all think consumer spending looks like, not just this year, but looking ahead into 2026?
We actually published on that today, where we published for the first time what we're thinking about 26. And our cash flow takes into account the income coming in, but also what the cash outflow looks like for the consumer as well to get to that net number. And from an income basis, we do think that's going to increase in 2026. You're going to see some more job growth. On an outflow basis with the with the interest easing, you're going to see less cash outflow necessarily. So you are going to see an accelerating rate from 25 to 26 in consumer cash flow growth. The fastest growth is actually coming from the middle because they are benefiting from the SALT tax, from tip tax being rescinded, whereas the lower is going to be dealing with a little bit more of the Medicaid and SNAP pullback.
Interesting. I want to talk about tariffs with you as well. The future of the Trump tariffs, some questions about that now. The retailers you cover, Kate, how have they been broadly navigating that? I mean, did you see them eating the cost? They're passing it along to Kate and Josh. Has it been a mixture of the two? What are you seeing?
Yeah, I think a mixture of the two is probably fair. I mean, these companies seem to be doing everything they can to mitigate the costs. It's coming in every way, shape, and form with vendor negotiations, finding ways to change the assortment so that you're not seeing as big of a cost. But you also are seeing some increased prices at retail. We do monitor it week on week, and starting in July, we started to see more items go up in price.
Interesting take there from Kate McShane from Goldman Sachs on consumer spending there. Okay, let's get a final check on futures. Now, US stock futures are trading in the green this morning after that ruling in a landmark antitrust case that refrained from forcing Google to sell its Chrome browser, though it did institute other requirements that could shake the tech giant's hold on search. Futures on the tech-heavy Nasdaq, you can see, up pretty strongly there, and the S&P 500 not far behind, but contracts on the Dow Jones, interestingly, pretty close to flat. And why? Well, that includes fewer tech stocks, so it's hovering just above the flat line, as you can see. Okay, now you really need to know about gold again. It keeps on climbing and it keeps hitting record highs, over $3,600 there. We told you a lot about it yesterday, and futures are pointing higher again, as we can see there too. So plenty of interest in the safe haven asset there. But on the flip side, Bitcoin, it's up today, but it's still in that 111,000 range, and it continues to struggle to really gain any momentum right now. Crypto traders are clearly looking for clarity from the Federal Reserve on its interest rate policy. And remember, we'll get an interest rate decision later this month. Let's turn over to European markets. And so far, it's been a much happier session here today as well. Markets firmly in the green. They're clearly boosted by that Google ruling. An individual stock to note is Watches of Switzerland. It jumped 8% in early trade following a trading update and a stock upgrade by Deutsche Bank. And finally, let's look at Asian markets and Asian Pacific markets. Well, they were pretty mixed on Wednesday overall. Investors are assessing there those rising global bond yields and the latest developments on the trade front as well. So worth keeping an eye on. The Nikkei there falling pretty heavily there though. Okay, well, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Ali Kanal ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.